G'day, I'm here to show you how to do the solutions to the 2014 exam question 2. Show you where I got it from. When you go to Task Accounting, you get to this side here and you have the exam papers. So when you click on the exam papers, you'll get this. But importantly, what I also wanted to show you, when you when you go to the site, there's also past exam, further exams, also the reports. So the reports here give you the answers, and this is the 2014 assessment report answers. This is what I'm trying to produce. I'm going to show you how to do it. Okay, let's make a start. So when you see this, you need to then do general journal entries for every entry. What I've done is, you can see there, I've put in the transaction, and that would normally form your narration. I'm not going to do the narration, so I'm going to show you how to do the individual general journal entries. So let's begin. So John starts a business by putting $25,000 into his private bank account. It's obviously got to do something with cash at bank because there's a receipt number there. So we have cash at bank, and that's going to be a debit. Whenever you put something into your bank account, it's a debit, it's an asset after all. And John is the owner, so it has to do with capital, and that's my credit entry there. There's my first entry done. The next entry, also on the 1st of April, we purchased some inventory, $13,200. We have got the complication of GST. It doesn't say bank, but the fact that it says check number 0001, that implies that we've used cash at bank. So let's make a start. So the three entries, the three accounts that I need is inventories. Whenever I buy something has got GST in it, I'm going to get a rebate back from the government. GST received, should be credits received, so they're the ones we get back. And the other account, in this case, as I've already identified, is cash at bank. Whenever we pay for an amount, it is a credit to our cash at bank account. In this instance, 13.2. Don't make the mistake of putting inventories of 13.2, because that's how much cash we have paid. Of that, an 11th, which is $1,200, is the GST, so that leaves $12,000 for the inventories debit to the to the debit to the inventories control account. Okay, back again. I've put a few colours here to make it easier to see. So for the next entry, purchase fixtures and fittings for $8,800. Again, GST is involved. Very much the same as this entry above, except we've got fixtures and fittings. We've got GST credits received. It's there. In this instance, we bought it not for cash, but on credit from retail suppliers. So we have to pay that business, and it forms a liability. So let's put that in first. 8,800 I owe to retail suppliers. Let's put it in the right part. Fixtures and fittings. If I spelt this thing right, it'll be good. In this instance, we've got 8,000 there, and when we divide the 8,800 by 11, we get $800, and that's our GST component that we're going to get back from the government. So two debits equaling that credit. So someone out the way. On the 1st of April, we paid for installation, fixtures and fittings. Again, that's got GST. It's relating to fixtures and fittings, but this time we paid cash for it. It's very similar to this one, except it's going to have cash there. Let's go and do that one. So it's fixtures and fittings. That's, in this instance, an 11th of that, which is 6. I beg your pardon, you've got to divide the 715 by 11. We get the GST component, which is there. I'm going backwards here a bit. GST credits received, that's 65, and in this instance we've got cash at bank, that's the amount that we paid for $715. You can see that this entry was a bit harder, or a bit more difficult to do because I didn't organise myself up. 715 you should put down there first, I think anyway, and the 11th of that is the GST, leaving the 650 for fixed fittings. It's important that goes to that account to add up to make the full value of the asset. Now we've got some sales. That involves two actual entries. So the first entry, we've got to record the sales. You see receipt number. That indicates that we've received some cash. So let's put that in. Cash at bank. And we received $3,300. That's how much cash we've received from them. We now have got the sales to record and the GST. In this instance, it's GST collected because we collected on behalf of the government. That GST collected is the 11th of that, which is 300. Therefore, the sales here are 3,000. Now, what we've done, we have looked at the sales side of things, but we also must record the goods that were sold and the cost of those goods, which here were $15. So we've got this account called cost of goods sold. That was $1,500, and importantly, we've got inventories going down. So inventories account went down by $1,500. Let's just check the logic of this. Cost is an expense, it's a debit. A decrease in an asset for inventories is going down there, so therefore we have that credit there. This next entry is quite simple. Wages is one of those ones where no GST is paid. That's $1,600. You can see that again it is a check number here, so we've got cash at bank, $1,600. That's quite easy. Okay. Now we've got a complicating entry here. John withdrew some inventory from the business for the personal use. We've got to be careful here. It's worth 110 to us. The fact that it had a sales value is immaterial. If we had sold it, we would have got 220 for it, but we're only accounting for the cost. So we have an account called drawings. We need to calculate the GST credits received component, and we need to adjust our inventories account because we have reduced our inventories. So inventories have been reduced by 100, and the $10 relates to the GST that we were going to credit against our GST collections, but what we have to do, we have to take that out away, so we get this entry here. So drawings 110, of which 100 comes out of the inventory, and we've credited back this amount for credit GST credits received. Here's another sale, but in this instance, this sale on the 30th was not for cash, but it was to a customer called the Party Place. So let's put in that first, Party Place, and the total they owe us is $2,200. It's relating to a sale, and whenever we make a sale, it's GST collected. That's 11th of 2,200, which is $200. Therefore, the sales are 2,000. That's quite easy. Like we did here before for this previous entry, what we need to do is to calculate the cost of goods that sold that it cost us, which here you can see was $990. There we have it. There are all the entries relating to question 2A. And what I will do is move on to question 2B. So here we are. We've just done question 2A, and we're going to go on to 2B. What you see here is a question which is presented in journals, the two types of journals. I've only taught you the T account ones, so they're the ones we're going to take notice of. So let's just go back to the my working spreadsheet. That's what you just saw, and what we have to do, we have to explain what this particular transaction was, that particular transaction, that's part 1 and 2, and then we have to do a disposal. So I'll do it bit by bit. The best way that I would go about dealing with this is to say, okay, what made this entry be debited in the delivery van account? So the easiest thing for me to use to explain is the actual general journal entry that would have been generated from the initial transaction. And down here I'll show you what it means. So in order to get a debit into the delivery van account, this transaction must have occurred. We bought a delivery van for $40,000 and it was paid for by cash. Right? So what we need to do is to simply write that the business purchased a van for cash. That's it. So what this is, that's the answer to the question, which generated this general journal entry. And when you then take this debit entry to the bank account, to the delivery van account, you've got the opposing credit entry or the reference to it placed in there like that. Similarly, now let's have a look at part B. We've got an accumulated delivery van, that's the opposing credit, if you like, to the depreciation expense delivery van. So what that is actually depreciation entry, and this is the entry that would have been generated. Depreciation delivery van, $4,500, accumulated depreciation, so it's a credit. So when we put this entry into the depreciation account, we get a debit, and the opposing entry, the credit entry to this entry, is this one. So simply, the answer to the question is the van was depreciated for 1 year. And there you have it. So that is the answer to part 2, which explains B. Now in part 3, we have to calculate the gain, loss and disposal. For that we need to know the delivery vehicle at cost, which is $40,000. We need to know the accumulated depreciation was only for 1 year, so it's $4,500. When we then calculate the written down value or the book value, we take that away from that, so that's minus that gives you that. We then compare it to how much cash we got. It says we received $30,000, that's a given. We then compare the two and we get a loss on disposal, because what we got was less than we thought it was worth. Had this figure been bigger, then we would have got a gain, but in this case we've got a loss on disposal. Alright, I hope that's been useful to you to answer question 2 in the 2014 exam. Thanks for listening.